Hello everyone, Gianni DePoce here with you for TheoTRADE, and today is Tuesday, the 25th of February, 2025, and we are still seeing stocks spin their wheels near the all-time highs. We're just a couple of days, I should say a few days away off from the record high in the S&P futures, but I will say this, there's been some notable deterioration in the market's internals. And what's interesting is that it really turned on a dime. I would say around Friday mid-afternoon, we saw consumer staples really start to gather momentum. Finished as the strongest performing sector on the week and has assumed 3-week leadership in the market right now. Healthcare also doing well, and so we're seeing sectors that are more oriented towards defensiveness and weakness outperform. So this sends us a very big signal, and so we raised a lot of cash last week going into the close, and we've seen some downside follow through. That being said, we still have not taken out any meaningful support zones. And so the big level here, the level I'm watching, is this low from the 13th of January. If we take that out to the downside, all hell could break loose in this stock market. I'm not fully convinced that it will because fear levels are still very high. And what I want to do today is talk about some of the pockets of strength and opportunity that we're witnessing and focus on those, because my contrarian take right now for the market is not necessarily that we're going to see a bear trend begin or a return to new all-time highs imminently. Instead, I'm looking for a more prolonged period of sideways action in this choppy range, basically above 5,800, below 6,200. I'm looking for stocks to build kind of a trading range in this 400-point interval, if you will, over the next series of weeks and perhaps even a couple of months. You take a look at the NASDAQ bearing the brunt of this sell-off here. The Dow is now positive on the day, but the Russell is down. And normally, when you're in a tape with the Dow leading to the upside and the NASDAQ leading to the downside, that's usually a risk off tape. But I think the biggest thing to pay attention to, and what we have been pounding the table on over the last couple of weeks, and this price action in the US really affirms this outlook, is the bullishness of the Chinese market. When you have a situation where US stocks are down and Chinese stocks are up, that tells me that big money is selling the US and buying China. So forget about the Magnificent Seven. You need to focus on the Terrific 10. We've been covering some of those names. We'll continue to look at those. But there's a big difference in the short-term price action between names like Alibaba and Amazon. Okay, Amazon at multi-month lows, whereas Alibaba is just a couple of days off from multi-year highs. Okay, you got other names in this space like JD.com, Tencent. These are looking pretty good. We've had a really good trade on GDS Holdings. So there's definitely things that are working in the Chinese market. But, one of the themes that we've seen play out time and time again coming out of this earnings season in the US is that the companies that have done well on their earnings and issued positive guidance, first of all, weren't always rewarded. We've had some instances where companies report very strong earnings and the stock gaps down. In the event where the stock didn't gap down, they weren't rewarded that much. You compare that to earnings misses. What I'm trying to say here is that we've seen earnings misses punished a lot more severely than earnings beats have been rewarded. And that really tells us a lot about the nature of this tape. You can see here Apple kind of bucking the trend here. We do have Nvidia earnings coming up today, or excuse me, tomorrow, which I think will make or break this market in the near term. We had talked about before in months past, over the last few months, how the failure for semiconductors to hit new all-time highs since July could have been a warning sign. And again, I'm not fully in the bearish camp yet. I'm more of a neutral zone right now. I think that stocks will eventually shake this off and make new highs, but the warning signs were there. This was the last box that needed to be checked by the bulls to give us the signal that the health of the bull market was a-okay, and that did not happen. Instead, we've seen consumer staples surge, and the performance spread between consumer staples and consumer discretionary has narrowed notably. Consumer discretionary has not hit a new high this year, whereas consumer staples is about to test its high from September. And so this looks like an area where we could see some opportunities and something to keep an eye on. And it's not just, flights to safety that we're seeing in stocks. We're seeing that in bond markets too, which I'll cover in just a moment. But you take a look at healthcare. Healthcare also starting to come back to life. We had a position that we picked up in Solventum yesterday in the chat room. That's seen some nice upside follow through up around 10%. But, just to give you some more context on what's happened in, these market gaps, you had names like Data last week that had a tremendous surge after its earnings beat. You had names like AppLovin that had a nice earnings beat. It's since given it all back. And then, you had names like TCOM that actually, had their earnings and beat expectations, and you gap down 10%. So that's the tape that we're dealing with right now. And elsewhere, you're seeing bonds start to accelerate to the upside, which is definitely noteworthy. You're seeing duration or long-term bonds outperform to the upside. And so this is something we need to keep a very close eye on. It is worth noting that the dollar has been selling off during this, so it tells me that a lot of it is domestic hedging. Okay, a little bit of uncertainty taking place in within the U.S. here, but with crude oil at multi-week lows here. Okay, this tells me that inflation is not really the threat. Instead, now my sights are on unemployment, and the Doge cuts, all the government cuts that we're seeing right now, could lead to an uptick in unemployment. Just something that we need to keep on the table right here. And this also increases the odds that the Fed's going to be a little bit more aggressive with rate cuts. So I'm looking at some rate sensitive plays. REITs could present some opportunities here. Not the most exciting sector to trade, but something to seek refuge in. I think, you have names like Rocket Mortgage here, Detroit-based mortgage lender that is showing some strength today, up 5%. So those are some of the sectors that we need to keep an eye on. Bitcoin and Ethereum getting liquidated here. Bitcoin and Ethereum both down almost 8%. Bitcoin is starting to break that key support zone of $88,000, $90,000. Can't rule out a drop back to the $80,000 level. Ethereum, I think most of the carnage is done here. Wouldn't be opposed to see a retest of the $2,000 to $2,200 support zone for what could turn out to be the final low in this market. So that's where we are right now, guys. We're risk off, and it changed very quickly. The first warning sign that we had a few weeks ago was the series of failed breakouts that we had on some seemingly good setups. And now we have the internals shifting at a sector level. Defensively oriented sectors are outperforming. Again, that can change quickly, but until proven otherwise, it tells us that we need to tread carefully in this tape, and we'll be approaching it from a much more cautionary standpoint than in the last couple of months. So that's all for now, everyone. Thank you so much for watching. And if you are looking for a short-term trading strategy, day trading strategy, I would encourage you to check out my friend and colleague's system, the Golden Setup by Tony Rago. You can check that out. You can find the details at TheoTRADE.com. That's all for now, everyone. Thank you so much for watching. Talk soon.